All right, welcome to The Explainer. Today, we're doing a complete visual breakdown of Catalaikos Dimitrios' groundbreaking 2026 white paper. We're going to take some seriously dense financial physics and, well, turn it into a journey that actually makes sense. Now, if you follow the markets, you're probably super used to staring at charts, candlesticks, moving averages, the whole shebang. But Dimitrios, he's asking us to zoom out, way out, and look at the structural universe of finance through a totally different lens. So think about this for a second. Is the stock market just a machine? Something that's constantly trying to take back to some static equilibrium of fair value? Or is it something way more volatile, like an ever-expanding universe with its own gravitational forces and actual physical laws? It's a huge cosmic question, and it really challenges everything we've been taught about traditional Newtonian economics. Okay, let's dive into this. For centuries, we've basically relied on this old metaphor from Adam Smith. We've treated the market like rising dough, a mass that just sort of puffs up as you add the ingredients of economic expansion. And sure, it's intuitive, but Dimitrios argues it's completely inadequate for today's reality. The market doesn't act like dough anymore. It acts like a rapidly expanding, ultra-hot cork-gluon plasma. It swells, it distorts, and it violently reorganizes itself as credit, liquidity, and our collective expectations just pour into it. To map this out, we've got a 6-part agenda today. 1. The expanding market plasma. 2. Credit fuel and rate thermostats. 3. FOMO and social market dynamics. 4. Geometry, temperature, and cohesion. 5. The quantum optics of market prices. And 6. The 5 theoretical levels. It's a structured roadmap, so don't worry. We'll navigate all these abstract concepts together. Section 1. The expanding market plasma. Act 1. Just like our physical universe started as this dense, totally undifferentiated cloud of matter that eventually cooled down to form local pockets like stars and galaxies, the economic universe does the exact same thing. That initial cloud of credit and liquidity, it cools and condenses. But instead of forming literal stars, the economic plasma creates these highly fragile, extreme valuation bubbles right at its outer edges. The overall expansion drives those long-term bull markets, but those local pockets, man, they are volatile. If an investor panics and liquidates at those extreme edges, they're essentially ejecting themselves right out of the plasma. Section 2. Credit fuel and rate thermostats. So what's actually driving this expansion? Well, the market's total volume expands through credit, debt, and bank loans. When commercial banks issue loans, they create deposits. They literally create purchasing power out of thin air. This means the market isn't just growing randomly, right? It's growing through a deeply structural mechanism of monetary policy and leverage. The real fuel for this plasma isn't just fundamental company earnings, it's the continuous, nonstop influx of credit. And this brilliantly illustrates how the whole system is controlled. Interest rates basically act as the universe's thermostat. They dictate the cost of money and determine exactly how aggressively the plasma is allowed to expand or contract. Decreasing rates? That leads to aggressive expansion, pushing risk assets way outward. But a sudden increase in rates? That turns down the thermostat, squeezing those fragile bubbles at the outer edges and causing some really violent system-wide repricing. Section 3. FOMO and social market dynamics. Act 2. The human element. In today's market, a stock is basically a social influencer. The ticker itself becomes a brand. Value isn't just something you discover in a spreadsheet anymore. It's transmitted socially. The fear of missing out, FOMO, pushes not just retail traders, but even the so-called smart money into the extreme, fragile outer edges of the plasma. Why? Well, purely for tactical positioning. They're forced to ride the wave of collective narratives, completely regardless of the underlying cash flows. And, this isn't a new phenomenon at all. These collective bubbles usually cluster around totally real fundamental changes. Just look at the 19th century railroads, the dot-com boom back in '99, or artificial intelligence today. The crowds are actually almost always right about the technological shift. Railroads absolutely changed the world, but they're almost always completely wrong about the timing and the extreme valuations. The narrative just outpaces the physics. Section 4. Geometry, temperature, and cohesion. Let's measure this plasma. First up is geometry. When the market is in a super strong momentum phase, it becomes highly nonlinear and convex. Small little shifts in human psychology start causing massive, outsized changes in valuation. And here's the measurement paradox. In these nonlinear regimes, your traditional linear tools, actually scratch that, all linear tools, become completely useless. An RSI reading over 70 doesn't automatically mean a drop is coming when the market is moving with that kind of extreme force. The tool itself is just structurally incompatible with the market's geometry at that specific moment. Next, we have temperature. Demetrios equates this directly to implied volatility. When implied volatility suddenly spikes without any real fundamental news, it means the plasma is stretching internally. It's signaling high intensity and a really wide expected dispersion of outcomes. So temperature isn't just measuring simple fear in the market, it's measuring the sheer, energetic stretching of the market's fabric. Finally, cohesion. This is all about liquidity quality. So the crucial point is this. A market might look perfectly stable on the surface, right? Prices are hitting all-time highs, everything looks great. But if bid-ask spreads are suddenly widening and the order books are thinning out, the market is losing its internal cohesion. It means the plasma is becoming dangerously fragile, and it's highly prone to violent gaps down the absolute second the narrative shifts. Section 5. Quantum optics of market prices. Zooming into the subatomic view. So classical economics views a price as a static Newtonian point, like a firm, objective number sitting on a chart. But the quantum view proposes something completely radical. It says a price is actually a wave function. It's a probability cloud shaped by expectations, liquidity, and narratives, and it literally exists in multiple potential states at the exact same time. Now, what's really interesting about this quote is the exact phrasing. The price is not, it becomes. Every single transaction in the market acts as an active quantum measurement. When a trade executes, boom, it temporarily collapses that probability cloud into a single hard number. But the very millisecond that trade is done, the system instantly recalculates, and the price goes right back to being a wave function of probabilities all over again. We can actually map the Heisenberg uncertainty principle directly to finance. In physics, you can't perfectly measure a particle's position and its momentum at the same time. Well, in the market, the more precisely you know a current price, down to the exact penny a stock is trading at, the less certain you can be of its future direction and speed. This isn't some flaw in your analysis, it's a structural, mathematical reality of the system itself. Because of this dynamic, a stock actually exists in a superposition. It's basically Schrödinger's portfolio. It's simultaneously undervalued for the value investor, overvalued for the short seller, and breaking out for the momentum trader. All of those realities exist at once. Plus, global assets are deeply, deeply entangled. When the 10-year treasury moves, tech stocks, gold, and crypto move instantly, not because someone made a conscious decision, but through the quantum entanglement of risk appetite and discount rates. Section 6. The 5 theoretical levels. Synthesizing the framework. Let's move to the macro view and see how this all builds together. We have geometry measuring non-linearity, temperature tracking volatility, cohesion monitoring liquidity, and quantum optics framing price as a wave function. But look at level 4, computation. Building heavily on the work of computer scientist Konstantinos Daskalakis, Demetrios points out that the market isn't just passively reflecting value. With millions of participants interacting, the market acts as a massive distributed computer actively calculating value in real time. The plasma actually thinks. This explainer gives us a completely revolutionary way to read risk and momentum, but it leaves us with one incredibly provocative final thought. If the market is a physical, expanding plasma fueled by credit, what happens when it reaches the absolute limits of economic entropy? What happens when debt accumulation and social rupture push the boundaries of this universe to their literal breaking point? Historically, the system doesn't just quietly stop, it is forced to fundamentally restart. And understanding exactly when that reset is coming, well, that's going to be the ultimate test for the modern investor. Keep exploring, and we'll see you next time.